So how to reduce your taxes? Here we are, 2022. And I want to talk about this in the context of financial planning, because everything I do is in the context of financial planning. If we optimize individual parts of our life, we may not get where we want to go. Financial planning is all about making sure we get where we want to go. And where's that? Well, here's one way to think of it. You're going to have a financial life. Things are going to happen for you financially, and you're going to end up somewhere in the future. And if you think of two different options, door number one is getting to do everything you want in life and affording it. And door number two is missing out on doing the things. Now, whether you get to do everything you want depends on a lot of things. And I would never say that financial planning will allow you to do everything that you want to do, but I can say that without planning, you're much more likely to go through door number two, and we don't want to do that. So just briefly, what is financial planning? To me, here's what it is. 4 key areas. Protect what you have, know where it goes. That's spending that nobody wants to talk about, but super important in our financial lives. Make it grow. That's investments. Retain independence and dignity. That means we're not going to live off of our kids in our older age. And we attack all of these with intention and purposeful effort, building your best financial life, not the best financial life on your block, but your best financial life. This is the way everyone should approach financial planning. Now, where do taxes fit in? Well, what I have on the screen is my planning process that I go through with clients. And I just wanted to show you where taxes fit in. So let me flip to the next page and I'll show you. Yep, that's right, everywhere. Taxes are everywhere. And our objective is not to avoid tax or evade tax. We never want to do that because we go to jail for that, right? We want to pay our proper taxes, but we don't want to pay more than we have to. And we want to optimize our assets, our investments, our planning, all of our choices. We want to take taxes into account for those choices. Now, we may end up paying more tax because we get to do something we want to do. Sometimes that's the case, but most often we want to pay less tax. And so how do we do that? Well, if there's one thing to remember from this presentation, here's how you pay the least amount of tax. If you knew exactly what your income is going to be the rest of your life, like the total number, right? $1 million, that's what I'm going to make in the rest of my career, 5 million, or whatever it is. If you could make the same amount each year, so take that 5 million or 10 million number, whatever it is, divided by the number of years you're going to work, that's your taxable income to have the lowest income tax rate. So, and the reason for that is because our tax scale is graduated, meaning it steps up. The higher you make, the higher you're taxed on that extra income. So for example, you can make up to $20,000, $19,750, and you would pay 10% of your taxable income. Or from 20,000 to 80,000, just rounding here to make it easy, you would pay 12%. So you pay 12% on the difference between 80 and 20, just that marginal increase, and so on down the line. Now, a lot of people think, well, I'm in the 35% tax bracket, so therefore I pay 35% in tax. Not true. You pay 35% in tax on the amount over 414,000. On the income up to that, you're paying these graduated levels. So you're probably averaging out somewhere around 24%. Big difference, big difference. Okay, enough of that. Well, let me just recap that again. One thing to remember, have level income. If you can move your income around, if this is a high income year and you could push some income into next year, do so. If this is a low income year and you have income next year that you can pull into this year, do that. Level your income from year to year to minimize your tax. But I want to go through 5 real life tips. And these all revolve around, if you pay attention, these all revolve around leveling your income. So number 1, Roth contributions. Now, this is interesting because this is one of the few areas where you never have to pay tax. You actually get income that you don't pay tax on, and you don't get those low municipal rates. You can invest in basically whatever you want. So Roth accounts are never taxed again. The money that goes in, you've paid tax on. It has to come from earnings, and you pay tax on that this year. And then the money goes into the Roth and it grows, you take it out, you don't pay any tax on the growth, as long as you follow all the IRA rules, which basically means that you use it for retirement or education, a few other things, but basically retirement. Now, in a Roth IRA, you can only contribute up to 144,000 or 214,000 if you're married. If your income is up to that level, you can contribute to a Roth IRA. If your income's over that level, you're out of luck. You can't put money in a Roth IRA. But there's no income limit for a Roth 401k. And most companies these days offer a Roth version of your 401k. So you can put your full 20,500 limit into Roth. You'll pay tax on that, right? You don't get a tax deduction, but it'll grow. And when you take it out in retirement, you won't ever pay tax again. The best time to do this is in your lower taxable income years. In other words, when you're younger for most people. If you're in your higher taxable income years, you'd rather not pay tax that year. You'd rather take a deduction and use the traditional 401k for that purpose. So that's number one, Roth contributions. That contributions means we're earning money and we're putting money into a Roth account from those earnings. Second one's going to sound similar, but it's different. Roth conversions. Now here we're taking a traditional IRA or 401k and we're converting the balance or a part of the balance to Roth. Now remember, a traditional IRA, we've not paid any tax on that money. We took a tax deduction when we earned it, put money into the 401k. Maybe we built up a 401k balance, we changed jobs, we rolled that 401k into an IRA, so we've got some money sitting in this IRA. We can take all or a part of that, convert it to Roth, and pay tax today on that amount. If you convert 10,000, then it's like you had $10,000 of extra income. That's how they're going to tax you. And there's no dollar limit. You can convert however much you want. But remember, once it's in Roth and it grows, you can take it out fully tax-free. So again, getting those Roth balances so that we're not paying any tax when we're pulling out money in retirement. Now, this does not work if you have basis in your IRAs. Okay, sorry for using that term. Here's what basis is. It's money that's already taxed. So this would be if you put money in an IRA and you did not take an income tax deduction and it's still sitting in the IRA, you cannot do this Roth conversion. It won't make sense the way the IRS makes you account for it. So you want to be sure you have no basis or no already taxed money in your traditional IRAs before you do a conversion. Again, there's no limit on this. So if you've got like a bunch that you want to do, you could do it over the course of 5 or 10 years. Just create a program and every, November, December, convert $5,000 a year, $15,000 a year, whatever it is. You'll report that as extra income. You'll get a 1099. Don't worry, they'll give you all the forms to do it, and you'll pay tax on it. But again, you'll get that money in Roth, so it'll grow from there. All right, number 3, asset location. So here we're talking about your long-term portfolio. Remember, you have a long-term portfolio that you have invested with money that you're not going to spend for at least 5 years. It's invested for the long term. Well, there's 3 different types of accounts you likely have. One is a taxable account, which is just a regular brokerage account that you open up from your checking account. You go to Schwab, Vanguard, wherever, open up account, write a check, boom, you got an investment account. That's a taxable investment account. 2 would be the traditional IRAs and 401ks, and 3 would be the Roth IRAs and 401ks. So taxable accounts, you're taxed today. As those investments are an income, you're taxed today. So we want to hold in those accounts, we want to hold low turnover, low income investments because we don't want to pay tax today. We want to push that off to retirement when our overall income is lower and our tax rates are lower. So we want those investments that are very steady. We're not going to trade them. They're not going to pay a lot of dividends or income. They're just going to grow. We want those in the tax today accounts, which is the taxable accounts. The traditional IRAs, 401ks, those are taxed at withdrawal. So we haven't paid tax on any of the money in there, and we're going to pay income tax on the money we take out. So for those, because we're not paying tax today, that's where we want our, if we have a high turnover strategy or high income investments or a bond portion of our allocation, that pays interest, that interest is usually higher than dividends. We want that in our traditional bucket, our traditional IRAs and 401ks, because we're not paying tax on that today. We're only going to pay tax later when we draw money out. And so we're going to avoid that. We're going to delay that tax. And then in the Roth IRA and 401ks, everybody knows this since the whole Peter Thiel story. These are the accounts that are never taxed again. This is where you want your supercharged high growth investments. You want those highest returning assets here. Word of caution, that does not mean you want to take a lot of risk in this account. Don't think about it that way. We've already defined the risk, but we put together our long-term portfolio before we even thought about our accounts. We're just looking inside that long-term portfolio and taking what we think is the highest returning assets and putting that portion in the Roth because we want it to grow and never pay tax on it. So there you go. If we allocate our portfolio across these three accounts in that way, we will reduce our lifetime tax on our portfolio. And that's another way to say, okay, we're going to still pay our fair share, right? Because we're paying tax on all these accounts just the way the rules say, but we're allocated our assets in such a way that we're minimizing the amount of tax that we'll actually pay, given whatever the returns are for our investments. All right, asset location, that's all about the investment strategy. Here we go to number 4, charitable donations. Now, this only works if you're already making charitable donations or if your plan is to make charitable donations, regardless of the tax effect. Okay, it never makes sense. The tax benefit's never big enough to force you to make donations. You're not going to make money by giving money to charity and getting tax write-offs. So forget that. This is for people who are already making those donations. So here's the deal. So the standard deduction on your taxes is $26,000 if you're married, $13,000 if you're single. That means you take your income, and no matter what deductions you have, mortgage interest, charitable, whatever, you can take at least the 26 for family or 13 for single. Now, if you have more deductions than those numbers, you can take those, but you got to have more. So here's the deal. Here's the strategy for people who give a lot to charity. Consider alternating years. You don't have to give the same amount each year. You can bunch it and give, let's say in 2022, you give a lot. In 2023, you don't. In 2024, you give a lot. And so you even out, you're given the same amount over time, but you get a better tax effect. And you can see that here in the example. Married couple normally gives $20,000 a year. If they give $40,000 in those bunched years and zero in the other years, they'll get a $40,000 deduction when they give to charity, and they'll still get a $26,000 deduction when they don't. If they give $20,000 every year, guess what? They're only going to get a $26,000 deduction every year. So they're missing out on some deduction by not bunching. So there's a lot more things we can do if you're charitably inclined. But this is a fairly easy one if you're giving around that amount. Okay, number 5, company stock sales. If you get equity awards from your company, make sure you fully understand how they're taxed and you're converting those, bringing those into the rest of your financial life in a tax-wise manner. Now, I'm talking about when you're selling your stock, of course. So you need to understand how they're taxed. That's number 1. And then number 2, create a strategy to bring it over in the right way. So for example, here's the biggest misconception that I hear from people. They say, well, I don't sell my RSUs because I want long-term capital gains. Well, guess what? On the day your RSUs vest, the IRS taxes you for the whole amount. So there is zero advantage to holding the stock past vesting, unless of course the stock goes up, but that's always better. If it goes down, you lose. But either way, there's no tax advantage to holding beyond vesting. So as a general rule, we want to sell our RSUs as they vest because we have no tax advantage beyond that. If we have, so that's the biggest one. That's the only one I wanted to cover because we're talking about so many things today. But if you have, more complex awards, it gets more complex. If you have an ESOP, if you have ISOs, all of that alphabet soup of stock awards. Just be sure you fully understand how they're taxed and that you've got a strategy that maps up with that to convert your funds over into the rest of your financial life. All right, so those are the 5 tips that I have about optimizing your taxes. Remember that, what was that one thing I said to remember? Yeah, even out your income. Even out your income. If you can move income around years, even it out. So that's great in general, but what about you? Well, here's what I suggest. Download these slides. You're going to get an email tomorrow with a link to download the slides and a replay to this video. And consider whether or not you're taking advantage of these 5 areas. And if you are, great. If you're not, or if you're not sure, schedule time with me. I'm offering a free coaching session. I normally charge $300 for those sessions, but this is totally free because you attended this webinar, and we'll determine your personal next steps. Again, no cost, no sales pitch, no commitment, none of that. Okay, so the disclaimer that's required, this is not financial advice. I've not told you anything specific to do because I don't know you, I don't know your situation. You gotta know all of that to really give advice. What we're talking about here are just tips and money moves. I do these webinars on a monthly basis. You can see the topics there below that I have replays available. Happy to share those if you like, and happy to cover other topics if there are other topics that are of interest to you. I have a lot of resources out there. There's a podcast that I do called Deliberate Money Moves. Very short tips. I mean, I'm talking like a 2 or 3 minute podcast each episode. Short tips on managing your financial life. A blog on my website, and some educational videos. And you can always email me with any questions you have. Next month, March 3rd, our webinar is going to be how to manage your ESPP. That's what we're focused on next month. And that's always a fun one. So that's the webinar as I have it prepared. Happy to answer any questions. Just put them in the chat or the Q&A. Oh, I forgot. I'm going to put the link here again for those of you who joined a little bit late. If you want to schedule time with me, just click the link there in the chat and that'll take you to my calendar. You can put time on my calendar and we'll get together. All right. So just a second. Let me have a little water and I'll check the questions. All right. Over the years, I have accumulated a lot of 401k traditional IRA assets. What's the strategy to move that out to a tax-free growth bucket? Good question. So for one thing, it's already in a tax deferred bucket. You haven't paid tax on it if it's traditional, right? So part of that money that's in there is not yours, it's the government's. So your question, how do I get out of paying taxes? How do I get it to a tax-free account? So the only account that's similar to that would be the Roth account. It's not a tax-free account, really. You pay tax on the way in. So that's how you do it. So this is where we were talking about Roth Conversions. Oh, let me get back to that slide. So what we're talking about is Roth Conversions, taking your IRA and converting it from traditional IRA to Roth, and you will pay tax on that conversion amount as if it's income, because you didn't pay tax on it when you originally put it in, and the government's going to get their tax. So that's what I think you're talking about. If you're young and you're looking for growth, that's not a bad strategy, because you move the money over to Roth. Yeah, you pay tax today on the current balance, but then it's invested and it grows, and you take that money out and you don't pay tax on the growth. So there's the tax-free part. You don't pay tax on the growth after it's there. That's the way to do that. Let me know if I didn't answer that question fully. I'm going to go on to the next one in the meantime, though. Okay, failed to understand the point about RSU taxes. No tax effect of selling at vest date. How does this work? Here's how it works. When you get a paycheck, your regular paycheck, you pay tax, right? The IRS says, you made $2,000 this period, so we're going to tax you for $2,000, right? Okay. When your RSUs vest, let's say you have $5,000 of RSUs to vest, the IRS says exactly the same thing. You just got compensation of $5,000 on vest date, So we're going to tax you on $5,000. Now, this is why in your custodian, they're selling some shares every time it vests. They're selling some shares and sending that money off to the IRS. That's the withholding. The unfortunate thing is they don't sell enough, so you end up likely owing some more at the end. But the fact is, they're taxing you on the value on vest date. So if you have stock that vests today and it's worth $5,000, then they've taxed you, or $10,000, they've taxed you on the $10,000. If you log into your account tomorrow and it's still worth $10,000 and you sell it, you don't pay any capital gain or loss because you've already paid tax on the $10,000 when it vested yesterday. So this is why it makes sense to just go ahead and sell it. If you're leaning towards selling the stock anyways, go ahead and sell it right after vest. There's no tax effect from doing that. The tax effect happens when you receive the stock. So that's going to happen no matter what. You've got no choice. You're going to have to pay that tax. So you can sell the stock and not worry about it. Another way to look at this is if instead of vesting RSUs, if your company wrote you a check for $10,000, would you go out and buy company stock for that $10,000? Have you ever taken a paycheck and said, oh, great, I've got this extra money, I'm going to go buy stock? No, I don't think you have. But if you're holding RSUs, that's exactly what you're doing. Your company is compensating you, giving you that $10,000 by not deciding to sell. You're effectively deciding to own the stock, and there's no tax effect from selling. So it's no different than them giving you cash and you buying the stock. So hopefully I've talked that enough. If not, please follow up questions, totally fine. Okay, is there a percent split of how much we should have in three asset locations? Tax accounts, taxable accounts, IRAs, Roth 401ks. Great question, insightful question. I don't really have an answer for you, but here's I don't have a specific answer, but here's the answer that I think makes the most sense. At least have some amount in all three, because all these tax laws, they're all going to change. And if you end up in retirement and all your money's in traditional and the tax laws have changed to favor Roth or taxable accounts, you're kind of screwed because all your money's in traditional. So because we can't tell the future what the tax laws are, we want to be diversified from a tax perspective by having some money in each of the three buckets. Okay, if you're younger, Roth makes more sense because you got more time for that growth to get the to not pay tax on that extra growth. If you're nearing retirement already and you're in a higher tax bracket, it's probably better to take the tax deduction and put money in the IRA, the traditional IRA, even if that's all you have. Because then when you retire and you have no income, you can then start converting some. And because you have no income, remember our graduated tax rates, you're going to pay very low tax rates on those conversions. So think about your taxes over the life when you come up with that strategy. But to answer your question, no, I don't really have a percentage number. I guess you could default to a third, a third, a third. I wouldn't target that though. I would just make sure I have some in all three. Okay, next question. What's better to reduce taxes, qualified or disqualified ESPP? Okay, good question. You're going to pay lower tax on qualified ESPP sales, but how much lower? You're going to pay long-term capital gains as opposed to income tax rates. It's going to end up being about 20%, 15 to 20% lower. The cost for doing that is you have to hold the ESP for between a year and a half, depending on how your plan is structured. So let me ask you this. You're going to hold stock for a year in order to pay 15 or 20% less tax. What's the possibility that while you're holding that stock, hoping to pay 15% less, what's the probability that your stock drops by 15%? Is that possible? I ask that question because if it drops by 15%, guess what? You just lost all the tax advantage that you were going for. Sometimes it's better to go ahead and pay the higher tax rate and diversify out into your long-term portfolio. Now, depends on how much company stock you have, what risk you want to take with that, all kinds of things. But that's the answer. To pay lower taxes, always do qualified ESPP. To get more money for yourself, it might make sense to do disqualified, even though you're paying higher tax. because you're taking the bird in the hand and you're not taking that risk that the company stock falls. Okay, how does it work for ESPP? We kind of just talked about that. It works very similar to RSUs, not exactly the same. With RSUs, you have to hold for a year to get the long-term gains. I just mentioned with ESPP, it's a year to a year and a half. The difference is the award date and the sign-up date. I forget the actual technical term for the ESPP. You have to be 2 years from the sign-up date. So on some plans, it could extend out to a year and a half because you normally, you got to wait at least 6 months before you get anything. So that's why it's a year and a half. But the strategy in my mind is really no difference. And it's because of what I just talked about. You're trying to pay 15% less in tax. And in exchange for that, you're focused on, you have to hold the stock for a period of time. And if your stock is at all moving around, that might be too much risk for you. Okay, let's see. Oh, same person. So how does it work for ESPP? And then are you taxed right away, similar to RSU? No, you're not taxed right away when the ESPP is awarded. But again, the tax rates work that it might still be better to go ahead and sell. All right, any other questions? Let's see. Okay, here's one. Is Roth conversion applicable to 401k accounts too? Should this be done? Yes, it is applicable. And should it be done? Depends on your situation. We've talked about a couple of situations where Roth conversions don't make sense. But yes, you can go from a traditional 401k direct to a Roth IRA. Most institutions allow you to do that. The law certainly allows you to do it. Some institutions won't allow you. Sometimes you may have to go from your 401k to a traditional IRA and then to a Roth IRA. So there may be, a step in between there. But yeah, the Roth conversion is totally applicable to traditional 401k balances. Now, if you're already contributing some Roth money to your 401k, maybe you've got it split, some traditional, some Roth. It may look like it's all in one bucket when you log into your custodian, but it's not. They've got the records to separate it out. And so you want to be careful when you're making that transition, because I've seen it happen where people have paid tax twice because custodians miscode or misunderstand exactly how the balances are structured and what they're doing. So you do want to be careful and be on top of that if you're making those changes. That's all the questions I see so far. If there's any other, just throw them in there. I'm happy to hang on for another minute or two. Oh, there's one. Gotta scroll. Okay, RSU tax case. All right, we've got a case. Here we go. RSU tax case. What if there's a price difference between time when RSUs were granted and when they vest next cycle? Are only capital gains taxed in this case? No. Here's how it works. Nobody cares about the grant price. The tax authorities don't care about the grant price. So, but it's a good question to ask. So when you get granted stock every year, assuming that happens, and they say, great job, here's $50,000 in stock, it's going to invest over the next 5 years, to make math easy. Then that's $10,000 a year. But it's not really $10,000 a year because they granted it today and it's not going to vest for another year. And so you get the number of shares today. It depends on the stock price 1 year from today. So let's say that $10,000, that portion that vests next year, let's say that turns into $20,000 next year. I think what your question is, do I pay capital gains on the difference between the 10 and 20? No, here's what happens. The IRS says on vest date, you got $20,000 of stock, $20,000 of value. That's $20,000 of income. It's just like a $20,000 payroll paycheck. We're going to tax you that way. That's how it works. I keep saying the IRS, but it's all state tax authorities as well. That's how RSUs are taxed. They're taxed fully as income on the date of vest. It's just like they gave you a paycheck and you turned around and bought stock. And again, I doubt that that's something you would do. But if it is, great, hold on to the stock. Otherwise, really seriously consider selling it because there's no tax advantage to holding it. So hopefully that answered that question.